Hello everyone. In this presentation, we will have a discussion on the Schedule 3 amendment that has been brought by the MCA. In this presentation, we will cover the Division 2 which is applicable for the India's financials. We all know that it is the Ministry of Corporate Affairs that brings amendment to Schedule 3 and within notification dated 24 March 2021, Ministry of Corporate Affairs has brought value adding disclosures amendment in the Schedule 3. This amendment has been made in three divisions. In all the three divisions, I will say that is Division 1, Division 2, and Division 3. This amendment basically provide vital information to the stakeholders which was otherwise not available to them. Then we will have our insight on the primary sources for the disclosures in the financial statements. We all know that there are n numbers of the disclosures that is required to be given in the financial statement, but some of the important sources are: first one is accounting standard, whether Ind AS or accounting standard. Second one is Schedule 3 of the Companies Act, the amendment of which we will discuss now. Third one is provisions of Companies Act like Section 186, 188. Fourth one is MSME Act, which requires the disclosures of the amount outstanding, including interest due thereon, and some of them are other. Now we will see what is the purpose of the amendment. The purpose of the amendment is to bring more transparency, more disclosure, which will help the stakeholders in making their informed decisions. Most of the amendments are in line with the CARO 2020. This will enable the company to disclose those informations which were not under the cloud of the CARO 2020. We all know that it is Schedule 3 that prescribes the format of the financial statements to be prepared, because none of the Ind AS or AS itself says or provide the format of financial statement. So the basic compliance of the financial statement should be with the Schedule 3. This amendment has been made applicable for the financial statements having accounting period starting from 1st April 2021. This amendment has been divided into three. This amendment has been brought to all the divisions, that is Division 1, which is applicable to the companies having financial statements in compliance with the accounting standard, Division 2, which is applicable for the Ind AS financial statements, and Division 3, which is applicable for the Ind AS financial statements prepared by the non-banking financial companies. In this presentation, we will cover the Division 2 and only the amendment part. We will not have a complete insight on the Schedule 3 Division 2, but only focus on the changes that has been brought by the Ministry of Corporate Affairs with a notification dated 24 March 2021. This is the snapshot of the balance sheet that shows the assets part, non-current assets and the current assets, and this one is the equity and the liabilities part. As we can see that there are some of the heads has been highlighted because major of the amendments, or I can say 99% of the amendments, are with these items. Some items has been changed, some items has been regrouped, some items requires more disclosures now than earlier. Now we will discuss the changes, the additional disclosures, the regrouping, the reclassification that has been brought by this amendment in Schedule 3 Division 2. The first changes that have been made in the rounding of figures in the appearing in the financial statement. Let us first be very clear about the concept of financial statement. As per Ind AS 1, the financial statement means balance sheet, profit and loss account, statement of changes in equity, cash flow statement, and notes to accounts. Now, this amendment basically requires the company to round off the figures appearing in the financial statements. Earlier, this option was optional, not mandatory, but now the company will have to round off the figures appearing in the financial statements, and the criteria for that has been changed from the turnover to the total income. Yes, rest are same. Now let's then comes to the non-current assets. We all know that we provide reconciliation of the gross and net carrying amount of each class of the assets at the beginning and at the end of the period, showing the addition, disposals, acquisition for business combinations, and the adjustments of the depreciation, impairment, or reversal thereof. But now an additional requirement has been brought by the amendment, which requires the company to show the changes made due to revaluation, and if such amount of change is either 10% or more in both sides, either upward revaluation or downward revaluations of the net carrying value of the property, plant, equipment, and other intangible assets. Next amendment is for the title deed not held in the name of the company. We all know that CARO 2020 also requires this disclosures, but now the management of the company will also have to make this disclosures in the financial statement with regard to the immovable property, that is land or building, of which the company is not holding the title deed. The important part of this amendment is that whenever immovable property come in our mind, we basically focus on property, plant, equipment. We forget about the concept that the same land or building may be classified as investment property, or it may be held as non-current asset held for sale. So in that case, it will not be included under property, plant, equipment. So we will have to see the balance sheet and then check whether the land or building is included in PPE or even in investment property or in non-current asset held for sale. Both these items, all these categories has been covered, and then the gross carrying value will be reported, and the title deed holder, whether the title deed holder is a promoter, director, or any related party of the company, and the date when such property held, and the reasons including dispute has to be reported. Next amendment relates to the fair valuation. We all know that the companies has been provided an option to measure the property, plant, equipment, including ROU asset, right of use asset, or intangible asset, at either cost model or revaluation model. So if the company has opted for the revaluation model, then the company will have to get the revaluation of these assets. And so the amendment requires the company to disclose the fact whether the revaluation of these assets has been done by the registered valuer or not. And Ind AS 40, that is investment property, also requires the company to make a disclosures of the investment property regarding the fair valuation, because investment property is carried at cost model. Revaluation model is not applicable for the investment property, but only for the disclosure purpose, fair valuation is required. So the same is also applicable for the investment property. Now, next two slides relates to work in progress, either physical substance or non-physical substance. You all know what I mean. I mean that capital work in progress related to those assets which have physical substance, and intangible asset under development which do not have physical substance. Now, for these two types of assets, the two tables has been added. The first relates to the aging schedule of those projects that is in progress, or those projects which has been temporarily suspended. These amendments have been basically made, which will help the stakeholders in deciding, and auditors also in deciding, the temporarily suspended projects and the capitalization of expenditure to those projects. If a project has been temporarily suspended, it may also require the management to impair the asset, to carry out the impairment testing. Yes. And the second table requires the disclosures of those capital projects which is overrun in terms of its cost or in terms of its time, and these details has to be given project wise. Say for example, the project 1 that was decided to be allocated of amount says 100 crore, but now it has exceeded its cost to the tune of 120 crore, then this project will be disclosed. and its aging will also be required to be disclosed. And another example maybe, say for example, a project that was to be completed within a period of 10 years, but now its tenure has been extended to next 5 years. So those projects will also be covered. Same types of disclosures are required for the intangible assets under development. And in the first table, as we can see, there is a star mark in the total. Means total of these tables should tally with the figures appearing in the face of the balance sheet. Next comes to the disclosures relating to the Benami property. So where any proceedings that has been initiated or pending against a company for holding any Benami property, then the company will make disclosures in the financial statement about the details of the property, whether it is land, whether it is building, amount thereof, what is the amount of those assets, details of the beneficiaries, who are the ultimate beneficiaries, and whether the same has been recorded in the books of account or not, and some other disclosures. These disclosures is also covered in CARO 2020. Next comes to the trade receivables. Trade receivables, which was earlier sub-classified into three categories, now has been extended to four, and some words has also been changed. And the unbilled dues shall also be disclosed separately, for which the bill has not been raised. And for trade receivables, aging schedule has also been required to be reported, which the management is reviewing in quarter basis or monthly basis. And these trade receivables has to be classified into six categories. One related to undisputed, and the second one is disputed. And these aging schedule has to be considered from the date of the due date, but if the due date is not mentioned, then from the date of transaction will be considered. In case of loans, we all know that earlier security deposit was included in loans, but now it has been removed from security deposits and transferred to non-current assets. Only those security deposits will be transferred to non-current asset which are not refundable, which are adjustable against expenses. And as we discussed for the trade receivables, same disclosures has been changed for the loans, for which the subclassification has now include 4 points. In case of other financial assets, bank deposits with more than 12 months will be now in the face of the notes. Earlier it was included into others, and now the other non-current assets include the security deposit which are not refundable. Now let's come to the current assets. In case of current assets, the first one relates to trade receivables and the second one relates to the loans. Same amendment that we just discussed in the non-current assets part. This one is a new disclosure requirement. This requires a company to disclose the details of the loans advances to the related party, that is promoters, directors, KMPs, and the related parties as defined in the Companies Act, that is section 2 subsection 76. And only those loans or advances are covered here which are either repayable on demand or for which there is no specified terms or period of repayment, means which are impliedly repayable on demand. So the disclosure will be as such in the table as depicted, like type of borrower, then the amount of loan and the percentage of total incentive disclosed. Same that we have discussed in other non-current assets, security deposit has been classified under this act, which are not refundable. Now these disclosures of working capital loan also align with the CARO 2020 requirement. Here the disclosures is for the companies who has borrowings from the banks and financial institutions on the basis of current assets, means the term loans, letter of credits, bank OD, which are not on the basis of security of current asset, which will not be covered here. And the company will disclose whether the quarterly returns filed by the company to the banks or financial institutions are in agreement with the books of accounts or not. And if not, then the company will provide the reconciliation in the region of the material discrepancy. The material discrepancy will be decided based upon the judgment of the management and the auditor. Yes. Now let's come to the equity. We all know that we are reporting the list of the shareholders holding more than 5% in the company as on the balance sheet date and presenting date. But now the amendment also requires the company to disclose the shareholding of the promoters and the changes made during the year. The catch is that this disclosures will be made class of share wise. For example, promoter A is holding shares B of 2 each and same promoter is holding shares of 10 each. Then both the shares of different class shall be disclosed separately. And the promoter here means the promoter as defined under Companies Act. Percentage change shall also be reported, which are changes during the year. Let's come to the non-current liabilities. In case of other financial liabilities, the long-term maturity of financial lease obligations has been removed and it has been transferred to the face of the balance sheet. Now, the lease liabilities, whether current or not, will be in the face of the balance sheet. Earlier, it was under other financial liabilities. And another one is current maturity of the long-term borrowings has been included under other financial liabilities. Now, as we discussed in trade payables also requires now aging schedule, which will be given in the table as being given. And these first the trade payables has to be classified as MSME, others disputed, MSME disputed others, and thus the aging schedule will be required to be disclosed from the due date, and if the due date is not given, then from the date of transaction. In case of contingent liability and commitments, now the company will also have to disclose the details if the company has not used the borrowings for the purpose for which the company has taken. Now we will see the changes or the additional requirements made in the additional provisions. First one is a willful default. So where a company is declared willful defaulter, the company shall disclose the date of such declaration and the amount and nature of such default. The same requirement is also there in CARO. And next amendment is related to the transactions with the struck off. We all know that the company should not engage into any transaction with the company which has been struck off by the registrar of companies. So if the company enter into any transactions with the company that has been struck off under Companies Act, then the company shall disclose the following details as mentioned in the table: the name of the company, the nature of transactions, balance outstanding, and the relationships. For this, the company can simply download the list of the companies struck off from the MCA website and then check from its list of the parties like trade payables, trade receivables, loans given, loan receivables, loans payables, whether their parties are included in that list or not. And then the company will make disclosures for the transaction that has been entered into. Next amendment is related to the charges. We all know that the company has to register the creation of charge and register the satisfaction of charge with the register of companies for which already there is specified due date. But if any charges or satisfaction thereof has not been registered with the ROC and are still to be registered and the statutory period, that the due date, has lapsed, then in that case the details of such charges and the reasons why these charges has not been registered with the ROC within the due date shall be disclosed in the financial statements. Next one relates to the number of players of companies. So the company which is not compared with the number of players as per 287, the company will disclose the details as well. Next, disclosures is very important for all the stakeholders. Now the company will have to provide the following ratios, that is total of 13 ratios have been specified, and these ratios are very useful to all the stakeholders, where banks, be it bank, creditors, government, investors, whatever. Now the management of the company will have to disclose these ratios on the face of the financial statement. And along with such disclosure, the management will have to give explanation of each item considered in the numerator part or denominator part. For example, let's take a current ratio. Current ratio basically means current asset by current liability. So the company will have to provide the explanation what constitutes current asset and what constitutes current liability for the calculation of current ratio. And next most important part is, if the company conclude that there is a change of more than 25% of this ratio in comparison to the earlier period, that is previous period, then company will have to provide a reason there. For example, debt equity ratio has been changed from 1 to 2, then the company will have to disclose the reasons of such changes. These changes and this additional disclosures is very vital for the stakeholders. Next additional requirement is related to the surrendered income. The company will have to give the details of the transactions that was not recorded in the books of account but has been surrendered in the income tax assessment during the year under the Income Tax Act 1960. Next relates to the corporate social responsibility. So where a company which is covered under section 135 of the Companies Act, the company will disclose the following with regard to the CSR activities. The amount required to be spent by the company, say 100, the amount of expenditure incurred, say 75, shortfall at the end of the year, 25, total of the previous year's shortfall, say 10, reason of shortfall, and the nature of the CSR activities shall be required. Next relates to the cryptocurrency or virtual currency. So if the company has traded or invested in the cryptocurrency or virtual currency during the financial year, then the company will have to disclose the profit or loss transactions arising from such cryptocurrency or virtual currency. Next one, amount of currency held as on 31st March of the balance sheet as on the reporting date, and the deposits or advances from any person for the purpose of trading in such currencies. This one is the last one, and this requires the company to disclose the details. If the company has given loan or made investment to the company, of giving such loans or investment, the company knows that the investing company or the loan receiving company will further invest or will further give loan to another company. For example, company A has given loan to company B, and at the time of giving loan, the company A knows that, or A has given loan to B with the understanding that B will further give loan to the C, then the A will disclose the date and amount of the fund advanced to the B, the date and amount of fund further advanced by B to C, the date and amount on behalf of the C. Next relates to the where the company is intermediary company. So this means B, company B. Here we are talking about the company B. So if a company B has received a loan from A, and at the time of receiving money, company B has a knowledge that company B will further give loan to the C. So the same disclosures will be applicable for company B also. And that's it. We have covered all the almost 99% of the changes made in the Schedule 3 Division 2 brought by the MCA dated 24 March 2021. Thank you. Stay safe.